All right. Welcome, everyone. So, before we begin, I want to just jump in with what is going on in the economy. So, today, the unemployment numbers came out, and they're very, very clear, showing us that it's a signal for the economy slowdown. And, most people hear the economy slow down and instantly start panicking and going into fear. But if you really slow down and think about what this really means, it means people are just uncertain. It means that people don't want to do anything right now. And that reaction is based out of fear, out of panic, out of uncertainty, not out of understanding. So when we truly understand the market, if you study the market, you know what's going on, you already know that slowdowns really mark the beginning of the greatest opportunities that's ahead of us. So this is really the phase in our market cycle where prices reset, and a lot of people are in fear, which means the smart investors really can position themselves in a good place as the recovery period ends. So on today's call here, we're going to understand what these numbers actually mean and not to react to all the headlines. We're going to be able to really look at what the market indicators are, and that way each one of you guys that are watching and listening to this, you guys move with confidence rather than from guessing. And confidence is really born out of understanding and knowledge. And understanding and knowledge comes from a commitment from yourself to learn what is going on. So if you're watching this, kudos to you. And every Monday and every Thursday, we do these investor education series so that we can help provide clarity, provide data. And those of you guys that are really wanting to take advantage of this cycle can move with confidence. All right, so we're gonna break it all down here today. Thank you guys again for joining us, and I'm gonna just get started. So let me open up the webinar here with the screen share. On. Okay. So, welcome to Building Wealth Through Real Estate. And before we get started here, I want everyone to know that we have free community resources. Our Monday night calls are at 7 p.m. Our Thursday calls are at 1 p.m. Pacific. And we have a free Legends WhatsApp group. We have a Facebook page. We also have a free school community. So you can scan the QR code here and join any of these things for free. This is our free resources that we offer to the community. And on today's agenda, we are going to continue understanding the market shifts. We're going to really move with logic. We're going to understand commercial real estate, how we got to where we are today. And the goal and hope is that you each leave here with confidence and clarity. So this is one of my favorite charts to start with, especially in today's times. We want to know that there are four phases in a market cycle. One is recovery, which comes immediately after correction. And we go into expansion, we go into hypersupply, and then back into correction. So this is how the market moves. And it doesn't matter if you're in stocks, real estate, crypto, commodities, whatever, everything moves in the cycle. And typically what happens in real estate is when you're in the period of recovery, right? So we're kind of in a place of like recession and correction right now. So when we move into recovery, I like to start in recovery because this is actually where I started my real estate journey. There's no new construction because we have just gone through a correction period and people really, the prices reset. This is what happens during a correction period, is that the prices reset and we move into this recovery period. And for a while, this is where you ride the market up. And this horizontal line here is, above the horizontal line is what we call a seller's market. Below the horizontal line is a buyer's market. So this is what a cycle looks like. It goes from recovery. People are starting to make money. Those that are riding this wave up is going to make a lot of money, which is what we're going to talk about here today. And, as it rides up above, you guys will see what happens in the market. When you put a property up on the market, there's 4 different buyers, there's a bidding war, there's a lot of excitement and a lot more buyers than there are sellers. And typically during that time, because there are more buyers and there are more sellers, a lot of new construction begins to happen because that's an opportunity. So there's people start to build, right? You're going to see a lot of statistics and headlines of, the housing shortage, how much housing shortage there are. And everything is pointing to that we just need to build more things. And so they're going to keep building. Everyone's going to build and everyone's going to over purchase. Typically interest rates are pretty low at this time, where there is a great condition for buyers to buy, whether it's low interest loans or high LTVs. In 07, 08, you saw that people were able to leverage loans that were greater than the value of their price, which is crazy. There were people that were getting loans for houses and properties and getting money back from buying a property. And, like a school teacher was able to buy 4, 5, 6 houses. Loans were recklessly being given out. So during those times, that it's an indicator that something is going to reset soon, right? And then it goes into this period of hypersupply. There's too many buyers. People were buying at such high prices, and the market needs to reset. In 2022, it looks like interest rates flying up. Right, it goes so high up that people can't buy anymore. It's to reset the market. And you have a lot of people going into panic because they're still building. They're in the building processes. All of a sudden, you have high vacancy rates. You have people that, you have developers that can't sell their properties. They're building way too much and they're worried about it. You can see some of the biggest players out there that are developers like, what is that? D.R. Horton. They're one of the biggest developers. They're offering like 3%, 4% interest rate for properties. And the reason why they're doing that is they're actually comping themselves upwards. You're paying a premium with a lower interest rate, and you think that you're getting, the best product because it's new. But what really is happening is you're overpaying even in a correction market like this, right? So a lot of people are also getting into trouble. D.R. Horton is showing that there's a lot more delinquency on their new construction already. I mean, it hasn't even been that long. Within like 1 or 2 years, people are upside down already. And those are all signs of developers also looking to take a cut, right? They need to take a haircut so that they can get these things off their books and they can prepare for the next cycle, and they need to get out. So right now, if you just think about emotions, right? Emotions in the country, there's a lot of uncertainty. There's a lot of fear. People don't want to get into real estate. This is really the time of great opportunity. All right. And if you look at where we are today, Warren Buffett actually has a chart. When Warren Buffett says when to buy, he actually has a chart where it points somewhere up here. He's like, you can start buying as soon as you see the market start heading down. So before we even go into anything, I just want people to really understand that there are 4 phases of any cycle when you invest, stocks, real estate, whatever it be. There are cycles, and you want to be buying when it's low, right? You want to be buying when it's low. So I'm gonna also start today with, oh man, my face is blocking. Oh well. But today's news, the unemployment rate came out, and Trump actually didn't want October's numbers to come out. He just wanted to show us that September, rates, unemployment did go up by 0.1%. So we've already been talking about this in the last couple calls, where unemployment rates just going up. Right, this is one of the Federal Reserve's mandate, is to make sure that we have a strong economy through its workforce. And Verizon just started cutting today. Amazon's been cutting. A lot of huge companies have been cutting. And I think the statistics, I have to double check this, but we're around 1 million plus this year already of jobs being lost. And so what does that really mean, right? A rising unemployment rate combined with a weak job growth signals a slowing of economic momentum. So this is directly from one of the news articles that I was pulling from. It's showing that we are in this place that the economy is slow. right? And typically, slowing of the momentum of the economy is just part of the correction period off of down here, right? In this correction period, the economy is really slow. So these are signals, these are signs, and I'm just for us to be able to read what these numbers really even mean, right? And for real estate, when the economy is weakened, usually borrowing becomes harder. The demand is softened, and I'll show you guys statistics here on today's call as well of exactly, and this is really exactly the time that opportunities really rise for us as buyers, because sellers are going to become way motivated. I'm going to give you all the different data and indicators showing you guys how this is so, proving to you guys that, this is not a theory. This is literally what's happening. Being able to understand what these headlines even mean for you, and what you should be doing with your money. That's the purpose of these calls, And so when the labor market is cooling, it also means that rates might stay elevated for a little bit. So if we're kind of stabilizing, you see that these unemployment rates, once it starts to stabilize, the Federal Reserve doesn't really have this motivation to stimulate the economy. And I'll talk about how they do that shortly here as well. But how they stimulate the economy when they don't have that motivation to do so, our interest rates could stay elevated for a little bit longer. And for you as a buyer, as an investor, it's actually a good thing that the rates stay elevated a little bit longer, because it means the buying opportunity is stretched out a little bit longer. It means that the sellers are distressed a little bit longer, and a lot of them can't hold out. And we'll talk about that. We'll talk about the foreclosure rates and delinquency rates and all of that as well. Just all data that backs exactly what we're looking at here. So, at the end of today's call, my goal is for everyone here and anyone that is watching this replay to recognize that we're really in a late correction period, almost like an early recovery window. Okay, and the slowdown usually is preceding a recovery in real estate. So we'll go through all the different datas, and you can decide for yourself where you think we are in the market. All right. Just high level of why there has been a commercial real estate crash. The primary cause of the crash is the high interest rates. From 2022 to 2023, rates jumped like they've never done before, 11 times in 9 months, I believe. 9 months, rates jumped 11 times. That means people that got into floating rates have no way of recovering their deal. Their interest rates jumped from 4.5%, 5% up to 10 and above, right? That's, for perspective-wise, that's a jump from, let's say your mortgage rates are at $450,000 at 4.5% interest rate. Jumping to 10 would be would be $1 million, right? It's more than double what you anticipate, and there's no way that anybody ever could really predict this. Right now, it's not about predicting this. It's also about knowing where we were in the market, and something like this is bound to happen to correct the market. Right? We saw how fast inflation was. We saw how fast rent was growing from 2021 to 2022, and we saw properties go up drastically. That means there's probably going to be a drastic correction, right? Hindsight 2020. If we look at it, then we could have even seen, this wouldn't really be an excuse that, oh my God, the rates jumped so many times. Some people that knew and understood the market cycles and all the indicators, they got rid of all of their properties during that time. They sold during a seller's market, and now they have cash ready to go, right? For this correction period. Now they get to sell high, buy low. That's logically, we get that. Sell high, buy low. Except most people invest and do the opposite. Buy high, sell low. It's so crazy. Logically, we understand it. Emotionally, we do the complete opposite. The other thing that happened, the reason why commercial real estate was crashing is also because of this low tenant demand. And low tenant demand comes from tons of new construction. A lot of new products being put out there, brand new products with better concessions, 3 months free rent. How does a older apartment building compete with that, right? So there's this low tenant demand, and so there's the operators and the owners of buildings have to come up with creative ways to get tenants in there or to keep tenants in there. Same thing happened in the office space. Office spaces, there was a lot of people no longer needing office spaces. When times get really tight, they got to figure out what they got to cut. And usually an office space is a massive overhead for a company if they can operate with people working remote and paying and lowering their overhead. This is why office spaces took one of the biggest hits in the entire correction period. And financial challenges, this is a big thing. Lenders tightened up their standards. We have lenders that were very loose in how they were lending. All of a sudden, their standards and their mandates changed. They want different types of insurance coverages. They're giving lower LTVs. They don't want to do certain types of deals. They're not doing certain, locations of deals. And some lenders actually pull out from commercial lending as a whole. They won't even do it anymore. So getting new loans and securing refinances are extremely tough during this time, and especially for properties that are upside down already, right? You go into a property, you underwrite it. It's supposed to be $350,000-$400,000 a year for your mortgage payments. All of a sudden, it's $1 million. They're upside down right off the bat. And if how long can somebody hold on to a property being negative $500,000 a year, right? So it's not a very long time, which means sellers are distressed, an opportunity for buyers. And as time drags on longer, there's no solutions really for the seller. They cannot refinance, they can't sell. They're just dragging on the inevitable, right? And the other thing that was happening was rising expenses. Construction costs went up, materials went up, insurance went through the roof, taxes gone up. So these are what we call like the fixed type of expenses that we don't really have control over. They're the uncontrollable expenses. So insurance, taxes, cost of material and labor, some of those things you just can't control. And the last thing is there is so much maturing debt coming. Okay, I'm going to show you guys actually in a chart here how much debt is maturing. When I say maturing, it means it's at the end of its life and the seller either needs to sell or refinance. Something needs to happen to change out the current loan. All right, so owners actually cannot refinance due to all the things that I just shared here. So there's a lot of stress that's coming up, and that presents some opportunities for us. So we're going to look at we talked about debt and delinquency rates, right? What I just shared there, here's a chart showing you the delinquency rates that are coming in or happening from 2024 to 2025. Okay, it's climbing, it's very sharp, and this is that delinquency rates rose 7.1%, worse since 2015 in multifamily, and in actually in the office spaces, it's actually worse of all time. Okay, in all of history, the office space delinquency and foreclosures is higher than ever. So lots of opportunities, lots of different real estate classes that you can get into, and you'll have great terms because sellers are stressed and lenders don't want to hold on to these properties. It costs lenders a lot of money to do so. So here is just the commercial real estate loan maturity from 2025 to 2027. In 2025, okay, that's this year, $957 billion of loans need to be refied or sold. And a lot of these are just also on this like month-to-month extension, or people are on, they've already been late for many months. The foreclosure notices are coming left and right. All right. And some of them, they may have pushed it out to 2026. But, 2025, why so much loans are due is because 2022 and 2021, There was so much transactions in commercial real estate happening, and majority of those loans are 2 to 3 years. So 2025 hits, all those loans are due, and nobody was able to refinance before that. So we have this massive number of deals that are the loans are due. Lenders are stressed. Okay, sellers are more stressed because they're going to lose all of their equity in the deal if it gets foreclosed on. Lenders don't really want it. This is not their business. They'd rather have you pay on time. That's how they make money. They don't want to go and run a property. 2026, there's already 539 billion coming due, and then 2027, 550 billion. So there's $2 trillion of commercial real estate loans due in the next 3 years. And if interest rates hold out longer, right? If they say, oh, Trump says, I don't know if he finagled these numbers or not, and why he's not showing the October unemployment rate, but it makes it seem like the economy's not doing that bad. Okay, there was actually like 115,000 or something like that jobs in created in September. But that was in certain sectors, and there was still a 0.1% increase in unemployment. So we want to be able to look beyond the tabloid headlines, looking at what all the numbers really mean and look behind it. We can look past, we can see through the facade when we understand these numbers. And this is my goal, is for you guys all to understand this so we can move together. Okay. This is something that I showed last week as well. This is a really interesting number. Most people don't really know what this is when I just post it, and they'll be a little bit shocked. This is actually Berkshire Hathaway's percentage of cash held. All right, and you can see during different, like, why Warren Buffett has been so successful. Warren Buffett has gone through, I think he said 17 market ups and downs, like recessions. And he claims that he will be alive for 2 more. I don't know, but I'm not really sure how old he is. He seems like he can go on for a long time. But in 2007, 2008, you can see that Warren Buffett had brought their cash reserves all the way up. They were selling. They were dumping a lot of things just to get the cash reserves up compared to the rest of their portfolio. It means 25% of Berkshire Hathaway's portfolio was in cash, right? And then took advantage, started buying all the things when they crashed. I mean, one of the biggest things that they bought that Warren Buffett talks about during one of the crashes was American Express. American Express had a huge default with somebody, and it tanked their stock prices. But Warren Buffett knew that their fundamentals was strong, and that really was a one-time thing. But when the economy's tough, defaults are going to happen all over, right? And so Warren Buffett started dumping his cash into assets, buying companies, buying real estate, all the way to 2010, and just kind of stabilized out. Now, again, here around 2022, around today, 2024, 2025, their cash reserves are now up to almost 30%. He's getting ready for something, right? So if you have cash, this is really the time you want to consider making the right moves with it. If there was a time to just go in at something, the market is all the indicators. Even the smartest investor in the world is indicating what he is preparing himself to do. And so he says, the best chance to deploy capital is when things are going down. And if you have not been following the news or real estate or anything, things have been going down. Okay, things have been going down very, very fast since 2022. And I think it will continue to level out, and things will continue to shake out in the next 12 to 24 months. So that's really our time, right? So how fast will you go into like educating yourself, getting yourself to a place of confidence to move? I hope these indicators, these are facts, right? These are facts, these are indicators, all history showing us what's going on. And I'll go a little bit deeper after this, but I just wanted to show you guys what has been going on in our market and what the news today was and what Warren Buffett's doing. He's selling everything. I think he just sold like $500 billion or something of of Bank of America. So a lot of these really smart investors right now are cashing up and they're waiting for, something good to buy. So this is what we all should be doing. We should be underwriting. We should be looking at deals. Our strategy today is we're looking at really distressed sellers. We're going straight to the lenders. We can find out when deals are being foreclosed on, so we can reach out to those lenders and see if we can grab deals that are even cheaper than the loan. I mean, these are big discounts in real estate. So here's just one more market data for just showing since 2022 how much things have been going down. Like if Warren Buffett has the best chance to deploy capital when things are going down, this is a chart that literally shows you how much things have been going down. All right, so all properties combined, negative 18%. And these statistics usually lag behind as well. So you can probably expect a lot of these to be much lower also, right? And if office buildings are an average of minus 38%, or was that 36% across the country, you might be able to find some office buildings that are 70% discounted, 80% discounted, 90% even, probably. There are a lot of really distressed deals, and then grab some, right? Figure out a way to buy some of these things. There's even, because it's such a buyer's market, you can negotiate really, really great terms like seller financing, right? There's a lot of sellers out there that can't even put any more money. They're so distressed. We're looking at a deal right now. Literally, the seller can't even put a hot boiler in the complex that half of the tenants don't have hot water. How do you? This is the condition of a deal that we're looking at right now. Half the tenants don't have hot water, right? So you can actually, if they're so distressed, you can come in and say, we'll do a seller finance. I'm going to inject $2 million, $3 million into this property. You hold the note for me. We're going to buy it, right? We can even negotiate no down payment, but we're going to inject $2-3 million in your property. Worst case scenario, we don't pay you. You take the property back, super improved. And now the seller's like, great. I mean, if I'm a seller right now, I was distressed like that, I would beg for somebody to come in and put $2-3 million into my property. I might even go as far as paying them a little bit to do so, right? That's the opportunity. There are deals out there like this, but you have to know how to find them. You have to know how to underwrite them, how to negotiate it. Most people won't even make a phone call, right? So we just let's let all of those fears go and move from facts, right, and the opportunities that are in front of us. And then what you can do with that seller finance, right? You have a deal locked up at $3.9 million. We go in, we do the work. All of a sudden, the deal's worth $7 million. We go refinance it. We get the money, pay the seller off. Boom, we own a property with no money out of pocket. Or, besides the renovation cost, but all of that also can be backed out from the refinance, right? So there's just a lot of great terms that you can negotiate in today's market. This is where people that are ready to hustle can make a lot of money, life-changing money from deals. Think about it. What would it mean for you to make $2 million on a deal? Like, what would you be willing to do? Most people aren't even willing to spend 1 hour a week prospecting and learning how to do this. Or just like waiting for something to happen. Well, don't be on the sidelines. This call is here to inspire you to take action as well. Okay, so just very quickly, I go over this a lot. I want people to understand what the Fed actually do and what how this affects our economy. Right, so the Fed has a dual mandate. One is inflation, controlling the stability of price, and the other one is to maximize employment. currently right now we're in a very interesting situation because we have an inflation, potentially an inflation problem, and we have high unemployment rates. So typically, if unemployment rate is high, the Fed just figures out how to stimulate the economy by pulling the lever to what they call quantitative easing. They invest back into the market so that the economy is stimulated. Okay, banks get stimulated, the government gets stimulated, and now there's more money to go around. That's what they do. But when they inject that money in, there's a risk of inflation going up. This is why we're like, there's no time where we're like, okay, inflation as zero is what we're aiming for, because that's not even possible. They just really try to keep inflation around what they call 2-3%. Probably not true either. We'll look at we'll look at a chart here in a second, and you decide for yourself. Now, when inflation is too high, right? They flip the lever the other way, and they tighten. They don't let money go into the market. They pull the money back out, and then the risk of unemployment happens. But they really stop the economy from growing too fast. That's the goal of the Fed, is that they have to control these two things. And so the way that the Feds stimulate the economy is they buy two things. These are the two things that the Federal Reserve mainly holds: is U.S. Treasuries, which is an IOU note from the government, and they come in the form of a short-term 5-year, 10-year, 30-year Treasuries, to pay the Federal Reserve back as the Federal Reserve lends money or buys these bonds. And then the other one is mortgage-backed securities. These are banks putting together the packages of loans and selling them all off in a package to the Federal Reserve. And the other one is bank reserves, which is also they lend money to banks as well. They lend money to banks, just kind of like this overnight rate that they have. And so we'll talk about that also here shortly. Two things that happen. Remember when I just said how they stimulate the economy? It's called quantitative easing. They go and they put money out into the market. When they put money into the market, with more money out there, inflation rises. But when inflation rises, assets and cost of things rise. Price of eggs, rent, apartment buildings, all of those things rise. And treasury bond yields go down. So interest rates kind of follow that a little bit. And then when they do quantitative tightening, which means they're tightening their balance sheet, now they're pulling money out of the market. And when that happens, the reset starts to happen. Okay, because inflation falls, the reset, things that were purchased at too high of a price, they get resetted, which is kind of what we're, just remember these two things, quantitative easing and tightening, as we go into our next slide, this graph here. And so there's a misconception of what the Federal Reserve rates are with interest rates when you buy a house. So it's typically made up of two things. One is the 10-year Treasury. So it's the IOUs that the government gives to the Federal Reserve. They pick the 10-year because the average loans usually are refinanced or sold within 10 years. So they choose the 10-year to kind of as the interest rate. And the other one is how much the banks charge on top of the 10-year Treasury. So today, the 10-year Treasury, I think, went up a little bit. It went to like 4.1 something. You add the bank's rate of 2.5 or 3 on there, your mortgage rates are going to be somewhere around 6.5, 7. That's how you would calculate them. Now, when the Federal Reserve buys the 10-year Treasury, the cost of the Treasury, the more that is bought, the price of this Treasury goes up. And then that means the returns go down. So the yield is what the interest rates follow. All right. So for example, if you get $20 on $1,000 that you invest into the Treasury bonds, you have a 2% yield. Now the bond prices, because there's a lot of purchase, the price goes up to $2,000, then the yield drops down to 1%. All right. So this is how interest rates are. This yield plus the bank's rates that they put on there. So banks rates also come from, will the Federal Reserve buy their mortgage-backed securities? How fast can they move their money? How much risk do they have? All right. This is the Federal Reserve balance sheet. When we talk about quantitative easing and tightening, easing is when money supply goes up, right? The balance sheet gets bigger and bigger and bigger. This is how much money they put out into the economy, how much money they put into circulation. So there is, in 2007, 2008, they injected a lot of money in, and that's why there was a lot of very interesting practices for lending. And then there was this crash that happened. Okay, around 2007, 2008, 2009, there's a financial crisis that happened when they decided they're going to tighten. They're like, oh, we put too much money out. We got to stop it. And then the correction happens. So this would be like a kind of, you call a recovery or hyper. When we go back up to this chart right here, we're either in, when that happens, like this goes up. So we're either in expansion and then hyper supply, and then it goes into correction. So just going back to this chart here. And you see that for a long period of time, they were injecting money slowly into the market, okay, keeping interest rates low. Real estate, basically from this time, from 2010 all the way to 2020, you couldn't make a mistake in real estate. And a lot of people got very undisciplined from it, because there's no need to understand real estate. You just buy anytime, do anything to it, make money. That was basically what was happening from 2010 to 2020. And then 2020, towards the end of 2020, the repo market blowout. This repo is the house that holds the bank reserves. Okay, so it's like how much the banks are actually needing to borrow. This number is shown from the Federal Reserve balance sheet of how much money banks are having to borrow, and that their reserves are lower and lower and lower, which, banks will collapse when their reserves get too low. And so that was happening. And so the Federal Reserve was like, okay, well, one, COVID was happening. Two, we're going to fix the economy right now just by injecting from like right under $4 trillion all the way to 9. And this was that period of, from 2020 all the way to 2022, ridiculous price increases in real estate. This was the time where people were calling the recession. Okay, if you remember, around COVID time, people were calling it. This recession was going to happen. Robert Kiyosaki was yelling this thing super loud, and the opposite happens. But what goes up like this must get corrected, right? So that from 2022 onwards, they were like, okay, we're cutting all the rates. We're no longer willing to put any more money out. We're going to tighten our balance sheet. When the 10-year bonds and the mortgage-backed securities are paid off, we're not reinvesting back. We're holding the money out. Their balance sheet goes down. So from 2022 to now, they have cut almost $3 trillion out of the market in a very, very fast period of time. All right, and this is very drastic, very huge moves. And then today, they're ending quantitative tightening. No more tightening. They're going to put more money out into the market. It might be a flat line for a little bit, but as they continue to invest back into the market, building investor confidence, the chart's gonna probably look like it's gonna go up again. So this is why we're in this correction period. We're deep in the correction period right now, just based on all of this. Now, there's probably still going to be a lot more deals that needs to fall out first, and the market is still correcting, so it presents a lot of buying opportunities for people. And this is this chart for the Federal Reserve, and this number doesn't lie, right? If you just understand this, you'll be in a pretty good position to understand where the market's always at. When you hear the news, you're listening for, okay, are they tightening or are they easing? What is Jerome Powell, what is the Federal Reserve doing? Based on the unemployment numbers that come out, based on the inflation numbers that come out, oh, I can see that the market is going to do this. The Federal Reserve must respond by doing X, Y, Z, right? Because that's their mandate. That's their mandate from the government. Their deal is that the government will have a central bank with the Federal Reserve. They're two separate entities. And as long as the Federal Reserve focuses on keeping a strong economy, monitoring the inflation, and then also keeping employment rates strong. So these are the two mandates, and both of those things are an issue. However, they just said they have inflation basically under control. That is no longer their primary objective. Their primary objective now is to make sure that the job market grows again, because there is this scenario in which AI replaces so many jobs that even injecting money back into the market might not support uh, job growth again, right? I don't know. But if money is being poured back and it goes into these AI companies and it grows even bigger and bigger and faster, there might be more jobs being lost. Or at least there's going to be a repositioning of that right now, and that'll be interesting to see what the Federal Reserve and the government does. That's why actually the Federal Reserve says that they are investing more of the money into U.S. treasuries than mortgage-backed securities. Even as mortgage-backed securities are being paid off, they're going to invest into treasuries because the government is probably going to have to create a lot of jobs. I don't know what the high-level goal might be, but that crisis perhaps will need the government to step in to create more government types of jobs, right? Who knows? But that's the condition and the status of our market here today and where we are in the cycle. But we are definitely down. Okay, this is definitely a correction period right now. You don't have to time the bottom of it. You just have to be able to get some great deals during this time. It's a buyer's market for sure. And this next chart basically shows that, right? In 2020 to 2022, you have way more buyers than there are sellers. And today, we have way more sellers than there are buyers. And here are just, if you look like where you're located, most of the Sun Belt, they call it, which is the states that are across kind of like the south and middle of the United States. It's called the Sun Belt. Better weather. It seemed like everybody was moving into the Sun Belt states: Florida, Texas, Georgia, Arizona, Vegas. Like they were getting heavy movement. So a lot of people were building extras, and there are overbuilding in those spaces, and so in Miami, Florida, especially, if you look at, there's 21,000 home sellers and only 7,280 home buyers. That means these buyers really get to pick and choose. They determine the terms, they determine the prices, and if these sellers are distressed, they have to make deals that make sense to them, right? That's going to alleviate the bleeding for them a little bit. So these are the buyers' markets. These are probably markets that are pretty good to get some good deals in, right? You're the one that's in control if you're investing and buying in any of these states. So Texas, Nevada, Vegas, yes, Vegas. A lot of Florida and Texas and Georgia, right? They're kind of just leading the way. And let's see. The next one is like sellers markets. These are states where you're going to purchase and you're not really going to have too much leverage. All right, so if you let's look at more balanced ones, right? So some of these states are more balanced. These cities are more balanced. And these are still sellers markets. That means you can probably put a deal on the market and within, 72 hours, you'll get offers. Okay, this is the sellers markets. A lot in New Jersey. I'm from New Jersey. My first property that I bought was in Newark, New Jersey. It's actually the biggest seller market right now. Interesting. So that's it for this conversation here. I'd love to just answer any other questions, or have anybody that is on with us chime in on what you are seeing and what are we missing here. Any questions, any comments that anybody want to add into this space?
Well, definitely, you're on point with your analysis. We're seeing it all over the place. We're definitely seeing a seller's market. We are seeing some opportunities with, across some markets where people are listing their properties and they're going pretty rapidly, but for the most part, it is a buyer's market right now. You can ask for concessions, you can ask for price reductions, and you should always talk to whoever's working on the loan because there could be a difference between getting a concession and getting a price reduction. There could be a bigger difference in just getting a concession and buying down your rate. So, um, it's a cool time to be in the market. If you're on the lending side, there's going to be so much opportunities to actually do business in the coming years.
Hmm.
I think if you're a real estate agent or a professional in the business, property management company, whatnot, um, it's a great time to be building relationships.
Hmm.
If you're not already doing so. And obviously, as we know, like the deals that we're seeing, I mean, we have this one deal under contract, but all these deals that we came across before we settled on this one deal, and it was like, which one is the best of the best? Because there's just so many opportunities out there. It's
Yeah.
just pretty insane.
So when I had mentioned that one of the challenges that we're seeing in these last couple years is that there's it's hard to find lenders, right? I mean, the lender um, the financing was tougher. Lenders were tightening their standards, and you're a commercial mortgage broker, so tell us a little bit about like what you saw in that time of like the lending, how their practices changed.
Yeah, I mean, so what, 3 years ago, 4 years ago, you were bringing a multifamily deal to the table, and every lender was like, "Yep, let's look at it. We're gonna lend and we're gonna jump on the terms because it was, you know, everybody gets, I don't want to say greedy, but they kind of let their guard down, right? So people let their guard down, they make the wrong investments, both as an investor and as a lender, you kind of make the wrong investment. And now we're definitely seeing a lot of lenders pull back. Lenders that were doing 80% loan to value on some multifamily deals that were doing 75% loan to values. Now they're not looking at refinancing it unless it's like 65 in a lot of cases.
Mm,
Even on the purchases, I mean, a lot of, when you're talking about just true multifamily in the small to mid space, they're not looking to lend unless you're putting at least 35% down. Their
yeah,
guidelines will say one thing, but they're not really lending on those. And, they have the higher DSCR ratios. Just, they're stress testing the deals a little bit more. So they're really analyzing the deals now and really saying, do I want to have this deal? And if I need to take over this deal, what's it going to look like?
yeah,
And I think an important distinction in what you said earlier is banks do not want to keep properties. They're not in the business of taking over real estate. They're in the business of collecting money from the interest and, satisfying their shareholders.
hmm,
So it's bank deals right now when they go under, I mean, they just want to get it off their books.
right. So, I mean, just to put into perspective for some of you guys that are listening to this and what all that LTV and all those things really mean, if you bought a $10 million property and you put, let's say 30%, or let's say you put 20% down, you put $2 million down. Now that the loan is due, even if they're like, okay, your property is still worth $10 million, we'll give you a loan on it, but we're only going to give you 65%. That means in order to refinance, nothing has happened. The deal is still good, right? It's still worth exactly the same. Now, in order to refinance, you have to come to the table with $1.5 million. Like, that's to put into perspective of what it means when the lenders tighten their standards. That's just one very, very simple example, let alone prices actually dropped, right? So now you have prices, your $10 million deal is now worth 8.5 million, and then they're giving you 65% from that. As a seller or as an operator, your loan is due, right? Now you owe this $8 million back, and the new lending that you get is $5 million, right? I mean, for somebody to like have bought a property thinking that they're going to make money, even if they were cash flow positive, even if they were cash flowing positive, all of a sudden you hit this refinance time, the loan is due. Remember, I shared $2 trillion coming due. That's the challenge that they're facing. So, wow. Thank you for sharing that. We got a little more time here. Does anybody else want to chime in, add anything to the space, or if you have anything else to share, Alex? And how do people contact you too? You have any way of contacting?
Yeah,
If you
so
if you
for
can put
me,
it in the chat,
yeah, I'll
you
put
put it
it
in the
in the
chat.
chat.
I'll ping it to the top.
Yeah, yeah. I think that, the biggest thing is like we talked about earlier, it's, education, continuing to educate yourself. If you have money set aside, be ready to deploy that money. There's going to be a lot of great opportunities. We're seeing them on a daily basis, right? So, just, but just don't educate yourself now and then say, I'm going to wait until, the stars align again. Like it's never gonna, the stars are never going to align.
Yeah.
You just got to make the right moves, be educated enough to make those moves. And you can make money in an up market, in a down market. You can always make money. It's just about getting educated and getting ready to deploy the money. And it's your money's losing money when it's sitting in the bank,
Hmm.
right? We talked about inflation. That's exactly what inflation is. Banks paying you 2 or 3%, and the cost of goods are going up 4 or 5%. Your
Yeah.
value is actually going down.
Hmm.
Um, in real estate, I mean, there's just so many benefits, tax benefits, long-term benefits, being able to take money out of the real estate in the future, out of your equity. I mean, there's just great opportunities all around.
Yeah, and during these times, I mean, during the down markets like this, and it's such a buyer's market, like it's very possible for somebody to turn zero from nothing to making $1 million on a deal, to making $2 million, $5 million on a deal. Like this is what is available, but you have to know how to do this. You have to be around the right people. Like, what room are you in? This is the thing that I always share. Like, who are the people surrounding you right now talking about money? Are they in fear, or are they the ones talking about how to find the right deals, how to negotiate the right deals, how to even reach out to lenders, right? This is something that nobody even knows how to do. This, you got to be around. You're not just taught this anywhere. You got to be around the people that are actually doing it, and surrounding yourself. This is a time, like you mentioned, relationships are so important during this time. And what's great is because brokers are also trying to figure out how to make some money and put food on the table. They're actually entertaining any conversation, right? In a seller's market, if you are not like proof of funds ready, you don't have a strong team, you don't have a strong experience, they don't even talk to you. But in today, they're like, man, we need to just find anybody that's potentially able to put an offer in. Literally, they're just like, put any offer in, put any offer in. Like I get that constantly, like, oh, whatever, just put whatever number. Everybody is such in panic mode. It's a great time for you to, even if you're new, to be able to establish these relationships, because you'll get the time, right? You'll get the time from brokers, you'll get the time from sellers, because people are panicking. They'll entertain anything. Yeah.
Yeah, and what you said is key. I mean, the rooms that you're in. I was having dinner yesterday with a group of investors, and you know, you kind of go around the room and you're talking and you're asking the questions, and these are all seasoned vets, and they're all saying this is a great time to buy, right?
Yeah.
Um, when you're in a different room, you're talking to people and they're like, "Oh, now's a horrible time to buy. The market is crashing," and those are the people that are obviously not reinvesting. They haven't maybe
They're
lived through the
emotions
cycle before.
driven.
They're emotions driven, and
Yeah.
and I mean, they're losing money, so they're concerned about what's going on. But I mean, I think after '08, everybody talks about how much money was to be made between like '08 and 2012 kind of thing.
Hmm.
And it was like the worst time to buy, and people were taking advantage of it and they were buying, and that's where millions and billions were made. So,
Yeah, I mean, Grant
yeah,
Cardone really came out huge on that. A lot of the big syndicators that have tens of thousands of doors came out huge. I remember one of my mentors, Robert Martinez, he was telling me that he bought properties $20,000 a door. And people were still thinking it was expensive at the time. He was buying 150, 200, 300 unit buildings at $20,000 a door. I mean, today they're like 160. I mean, that he 10x investors' monies. That was, I mean, it's
the
great.
first one in 53 a door.
Yeah.
And it was renting for like $1,100 a month, conservatively. I mean, you got to look at that. I mean, like we've talked about before about, now we're able to see the 1% rule again. So if you're buying a building, it's costing you $100,000 a door. You're looking at renting that place out for 1,100 $1,100 a month. That's the 1% rule. We're starting to see that again
Hmm.
on a lot of deals,
Yeah.
not just,
We can
uh,
even see 2%, 3% deals now.
yeah.
Yeah.
3 years ago, that didn't exist. If you were buying something and it was
No.
0.75, you were like, "Oh, this is a steal."
Yeah.
So the great thing is now you could really take advantage and you could look at all these opportunities and find like the opportunity for you
Hmm.
based on your criteria, which is what we've done, right? We found this deal in San Antonio based on the criteria we were looking for, and it was the best deal. It wasn't just some random deal, or it made sense. So you can really be strict right now in what you're looking for, and you can find it, which is way different from 2022.
Yeah, and you know who found the deal? Two complete newbies in our group just learned the process, learned what to do, found the deals. Found very quickly, found the deal within like a month and a
Yeah.
half. Month and a half of being in our program, found the slamming deal, and it's because they're willing to do the work. They know they have urgency, right? They get
Right.
what the opportunity here is in front of them. What is the risk of not doing anything is massive. So yeah,
Yeah.
awesome.
It's the
Um,
biggest risk in life. People don't realize that everything you do, every action you take, but also every action you don't take carries a major risk.
yes, huge
And-
risk.
But that's what people don't realize.
Yeah, and for a second here, just I'm gonna just roll us into something that we are doing now. Is I'm doing a 1 day virtual event on like this whole entire thing. It's just 1 day. You get really locked in on what to do. It's a 197 thing. We also have a really, really awesome event January 8th and 10th in 2026. This is a great way to start your new year. You're going to walk in there. 3 days later, you're going to walk out and be like, wow, I'm a completely different person. I have my power back. I know what I'm doing. Just really aligned. I have a community, and 2025 has beat up a lot of people. And so our event, this is the most proud event that I put on with two of my partners, is a live breakthrough event January 8th to the 10th. This is not one of those conferences that you go to and you're just listening to a bunch of people in the panel and people are just outside trying to network and raise capital from each other. This is literally breaking through all the things that has not worked, the subconscious mind, and then building really, really lifelong relationships and developing trust in this room. So it's a one of a kind. It's a early bird right now for that ticket is 500. So for anybody that is interested, and you're watching the replay of this, you can scan that QR code, and if you're actually watched it up to this point, you deserve to get a really great price on it. So it's $299 for both of those combined. December 20th for a 4-hour workshop. You're going to learn so much in that space. And then the 2026, January 8th to the 10th, amazing event, amazing workshop. We have, if you look in my Facebook or in my Instagram, we have actually a video showing, actually, I might just, no, I'm not going to play that. But it's a great video that we put together as the highlight reel for that event. So you guys can check it out in my Facebook and Instagram. And for anybody that watched all the way to this point, actually, we're gonna give you guys as a bonus something that we've been selling for a couple $1,000s, which is this is free course. If you buy this today, $299, you're also gonna be getting all of this stuff for free. This is a super great way to start. Go at your own pace, and then get more confident, get more clear as you go through both of these. This is the Foundations of Commercial Real Estate and then an Investor Education Series. If you are going to be investing with anybody, you should probably watch this video first, this set of series, the series of videos. It's like a 5 modules, and same with that. And it comes with a bunch of 20 plus worksheets that, man, I wish I had when I first got started. So this is just a bonus. And then for anybody else that sees this, I'm opening my calendar for a free one-on-one call, just to connect. Let me know how I can help you. So you can either go to alexlovely.com/1-1, or you can scan this QR code and make an appointment with me. So this is special for only those of you guys that actually are, have made it to this point. And wow, my face is in the way of this QR code. I should probably move my face. Oh, here we go. I'll put my face right here. And so you guys can actually scan that QR code. Okay. Back to we're going to be wrapping it up here. But this is Alex Panacho is a commercial broker. He's also an investor. He owns commercial real estate as well, which is, it's pretty rare. It's pretty rare to have, if you find a real estate broker that owns commercial real estate, if you find a mortgage broker that owns commercial real estate, they speak your language, right? There's so many that I speak to. I know they don't own anything. They only speak from a place of I'm selling something because this is the way I put food on my table. They don't understand from an investor perspective, right? So if you're really looking for knowledge as well, you can look up Alex in Instagram. You can find him on. He actually put his number right there. That's ballsy. Uh, so I guess as a mortgage broker, maybe this is your work phone or something, but
No, that's it, man. You can
that's your
text me or call me.
actual cell
WhatsApp.
phone. You just like
That's
anybody
it.
blows you up. Okay, cool. All right,
Yep.
well there it is,
Take it.
and lots of knowledge is a part of our community, our group as well as one of the pillars of our community. So yeah, we'll take
Yeah, but
maybe
and
yeah. Go ahead.
I was just gonna say right back at you. It's a shout out to you, and definitely if you guys are interested, I mean, come join the courses, come join the calls. I've not only learned a lot, even though I knew a lot already. I was like, what do I got to learn? I've learned a lot being here. But more importantly, the connections that we've made from being in these groups and in these chats. So if you're thinking about joining, learning about real estate, check it out. You can always reach out to me. I'm happy to share what I think, but there's a lot of great information both on the free side and in the master classes that Alex holds. So we'd love to see you guys there.
Yeah, thank you. And that was not
Yep.
planned, guys.
That was
That
not
was straight
planned.
from his heart, I think. Okay.
100%, man.
Great. Thank you for sharing your knowledge with us here. Does anybody else here want to share anything before we wrap it up here? Thank you guys for those of you guys that have tuned in up to this point. Appreciate and I if anybody is like if you're wanting to learn and you're like want to get in this game, like I want to help. I want to help not just because I'm super charitable or anything, but because the more that people invest and make money, and if I can help along on that journey, I know there's going to be a time that we have an opportunity to invest together. Right? We're looking for partners, we're looking for people to do deals with. So, yes. Anybody else want to chime in?
Hey Alex, Jeff Cassell, how you doing?
Great. Hold on, let me add you in here. Oops.
It's official. I'm there.
Hold on. I'm a little new at this.
You,
Hold on. It's going to happen. I want people to see who's speaking. There he is.
yeah. Ta-da! I'm
Ta-da.
here. Yeah, yeah.
How you doing?
I'm great. I'm great, man. So I was gonna say I've been through 89, 2008, and then the millennial bug in between. I can tell you that, this market is getting on that edge, but it's not there yet. It's gonna get worse.
Mm-hmm.
And it's coming, but it's just not there. I was repping Wells Fargo and Chase and a couple other banks as their high end asset managers. I was their agent for their high end assets, and I can tell you, banks have got to have that amount of money in their account for every loan. So even like in 2008, I had two commercial loans, and the bank, because I had one empty space more than they wanted on my loan docs, they actually came in and said, "Okay, we're going to foreclose on you,"
Whoa.
because and they handed me the paperwork, served me the whole bit. I had two loans, both office buildings. They didn't want office buildings, obviously, but my properties were, I think, 75% occupied versus 80%. And that one space being empty, they served me. And I said, "Look, guys, I'm 100% paid on time. I've got no issues. You guys are getting your payments. There's nothing here to foreclose on." They said, "No, you're not meeting the need." So my point is, make sure right now, if you have commercial property, read your loan docs again, because the market could be very tough very quick. And if you don't have the money, like I had the money to write a check for one of those loans, and my negotiation was, "Hey, I'm going to pay for one, and let's don't go to court and let's don't fight this in court.
Mm-hmm.
I'll pay for one, you keep me on the other one." And that's what they did. My point is that, there's going to be some real blood in the streets here shortly.
Yeah.
And when that time's, this owner finance deal, yeah, that's smart dude. That's very smart to do because you probably can't get it financed with $1 million or $2 million in rehab.
Nope.
And unless you're going bridge debt or even, some kind of other high percentage, personal loan type thing, hard money, because the banks are just going to take it down, cut it down, repair it, clean it, and put it back on the market at 50 cents on the dollar.
Yep.
And it's coming. And that's why I tell people just always wait for the right time. We're getting very close.
Yeah.
Unless the government steps in and does something major, I don't see that. I mean, I think tariffs are going to make an effect on the economy next year, like June, July, maybe August at the latest. But you're going to start seeing that. And if they don't get that fixed in the courts and whatever, saying it's illegal to do or not illegal to do, once they get that, that unsecure part of the economy from freaking out over him getting a tax, it'll get better. But my point is, it's coming. But it's just, I would tell you, pick and choose your deals. Be very careful. Even the best syndicators and best investors have bad deals.
Yeah.
And they do fall flat, and then there's nothing you can do except take the lump and move on to the next deal. So it's coming.
What do you think? I mean, we've seen a big crash already. I mean, it's lost a lot. I mean, real estate has lost a lot of value. I mean, you can get into deals now, even if there's more blood on the street, it's not really going to be your blood that's buying now. It's the people's blood that bought in 2022, 2021. So if you buy now, I think actually it's fairly safe that your blood's not going to be on the street. You may not buy at the bottom, but you're still going to be able to find really great terms. You're going to find really great deals at really great prices. So, not about timing the bottom, but really understanding what you're buying and what are the different strategies that you can use. Because it's really cool in today's times that you can really bring a lot of strategies together into a deal. Because if you can buy at a pretty low cost basis, there's a lot of things that you can do. You can combine some hard money. You can combine seller financing. You can make some really cool terms together in which you come out of pocket actually very, very little. So that's a possibility, in today's market only, not 2 years ago, not 3 years ago, not when sellers weren't even entertaining any of that. Right.
A lot of those deals are going to come around. I think you're going to get more creativeness in the market. What you were talking about with D.R. Horton.
Yeah.
I mean, I sold probably 4,000 investors. D.R. Horton, I was D.R. Horton's number one sales guy when the investor market was really kicking it.
Yeah.
I helped them create the products they were doing with that. And 2002 to 2007, like mid-year 2007, we sold 4,000 investors really in those 5-6 years. And a lot of those guys in 2008 and 2009, they went belly up because they were upside down, but they were offering great deals, interest rates, all the stuff that you could put into one. And I just I told everybody, hey, the market's getting too rich. I think we just need to sit and wait. And a lot of people kept going, and those who kept going, they went to foreclosure.
Yeah.
And they took the haircut. But that was on residential, a few in commercial. But I really think you got to make sure your loan docs are right on. Look at all your details. I know you don't want to grab that stuff and fall asleep reading it, but it's that time again to start really analyzing what you have, what kind of loan you have. I'm sure everybody in the loan business is probably telling you that right now.
Yeah.
You better look at your numbers and your docs.
What's really great is you can actually just upload docs into AI now and really get all the things and ask it all the questions like, where is there exposure for me, right? You can literally type it in. You just upload a doc into ChatGPT. Where am I exposed right here? And then you can negotiate from there. Then you can send it to an attorney and be like, hey, this is what Chat has told me. There's a way for you to double check the work now instead of having to read a 60-page, loan doc. Because who's actually reading that? I mean, every time I've signed the loan docs, here, this is where you sign like 1,000 different things. I'm not even like, by the time I'm signing my 10th time, I'm already like, I'm just ready to close the deal, And
Yeah,
so
after 2 hours of signing,
yeah,
your
I don't.
hand is numb.
Literally, they can probably. I mean, they tell me what's there, but I'm not really reading all of that, right? I mean, otherwise, this closing will take 10 hours for me to close. I'm like, I'm in 25 minutes. I'm out. Deal's closed. But now we can take that loan doc and we can stick it in ChatGPT, look for where the exposures are, and this is a way to be safer. That's a really great point. Thanks, Jeff, for mentioning that. How do people reach out to you? What is your contact? How do you want people to reach out to you, follow you, chat with you?
Well, I
Because
think
Jeff,
my cell phone, my cell phone's right here on the page. I think it's
well, in
under.
Zoom, but it's not really here on this
Got
the
it.
way we show. So if you type it in the chat, then I can actually put it up onto the screen. And Jeff's got a wealth of knowledge, and he's gone through a bunch of different cycles, and take advantage of it. If he's gonna leave his contact in here, and you have a chance to contact him, don't miss out.
Well, let's see. Easiest number is that, and I'll put in an email. So if somebody wants to email me, they can. And
Wow,
goodness,
everybody with putting their cell phones out there. That's great.
hey, the difference is that some people don't answer their phone, and I've done this for 35 years, and every one of my deals has always been relationship connection,
Yeah.
and people actually say, I can get in touch with you. I mean, literally, I've had 7 calls since we've been on this call, and they all go to voicemail, and I put, "Hey, unavailable. I'm on another call. I'll call you back," and it might be at 8 o'clock tonight, but you'll get a call back.
Mm-hmm. Awesome. Well, that's definitely true. Okay. Well, I think we're going to wrap it up here. We've gone to the top of the hour and some. Hopefully, you guys got a lot of information here. Again, Mondays, 7 p.m. This is our call with a lot of our community. This call right here on Thursday is a fairly new call. It's a hit or miss for people here, but I see that a lot of people actually has watched. We got 66 likes on here, so at least 66 people have come on for a short period of time or whatever. But, and hopefully more people will watch this. Thank you, Irvin. Thank you for being here. Thank you for that. Thank you for that shout out. And I will see you guys Monday or Thursday. Much blessings, everybody.
Thanks,
Later,
Alex.
Jeff.
Good to see you, buddy.
Thanks,
Everyone.
Alex.
Thanks, Alex. Thanks, Jeff.
Yep.
Take care.
Have a great one, guys.